So typically, the London market is an OTC physical metals trading market on precious metal space. And New York is really a futures paper derivative driven market. And typically a bullion trader will be long physical inventory or physical metal on their account in London from various mines selling gold to them from all over the world into LBMA vaults or, bank vaults, Brinks vaults, etc. And then it will typically sell equivalent futures to hedge that position in New York. So they basically are delta neutral, don't have a price risk, depending on, market moving higher or lower. What's been happening recently is due to the extortionate amount of gold that's been moving from London to New York, 2,000 tons plus, in December, almost every single flight was booked across the Atlantic with all the shipping logistic providers. You couldn't even get metal on a flight because they were so booked up for the next 2-3 months. And also the issue is participants have been taking gold out of a London physical market to move it to New York, but there are contract differentials for physical delivery. So in London, the OTC gold market typically is backed by a 400-ounce gold bar or a brick, as you would normally see. Now, you have to take that 400-ounce bar, refine it at a Swiss refinery or any LBMA London Good Delivery approved refinery, and then you'll have to ship that across the Atlantic into New York, and you can only deliver 100-ounce CME Good Delivery bars, or they call it 4.9 purity kilobars. Obviously, there's only a certain amount of refinery capacity that can do this. There are some LBMA refineries around the world, like there's Metalor in Singapore, there's Valcambi in Switzerland, there's Argol Heraeus in Switzerland, and then there's refineries in the US such as Asahi and Metalor as well. These refineries are now backed up by approximately 6 weeks, some of them even longer, and the refining rates obviously have gone through the roof. So there is a shortage of physical metal on the short term moving into New York, and a lot of these traders that are short futures on COMEX are trying to build up as much physical inventory as they possibly can before potential tariffs come in. Maybe they're announced they were supposed to be announced in 1st of February, then it could be March, could be April. No one really knows. Is it the threat of tariffs? Is it not tariffs? The likelihood is gold will probably not be tariffed because it's a monetary asset in America, and you would expect it not to attract tariffs. But in the current environment we're seeing with the Trump administration, everything's on the table. So it's actually sound risk management for traders and for market participants to load up on inventory in New York, and that's caused a real squeeze in London temporarily, whereby we've seen the forward curve that was traditionally a contango flip into a backwardation, and it's been metal's been in short supply in London.